Again, welcome to our introduction to financial statements. In this lesson, we are going to cover the statement of cash flows, or otherwise mentioned here as the cash flow statement. We will go over the components that make up the cash flow statement and record our company Libra's transactions on the cash flow statement using the same variables as those used on our income statement and balance sheet exercises. As covered in our earlier lessons, the statement of cash flows consists of cash from operating, investing, and financing activities, and tracks changes over a period of time, much like the income statement. So, as you may recall, there's monthly, quarterly, and yearly. So even though the cash flow statement is technically not necessary as one can work out the cash changes by comparing balance sheet items and income statement items, it is nonetheless extremely important. It exists for two main reasons. First, to account for non-cash income, expenses, or taxes on the income statement. These adjustments will mostly be made on the operating section. As you may remember from the income statement lesson, since we're using the accrual method of accounting, revenues and costs are recorded as a business earns or incurs them, but not as it receives actual cash. The actual receipt or use of cash will be shown on the cash flow statement. Second, to reflect cash inflows and outflows from investing and financing activities. For example, debt repayments and capital expenditures both affect cash usage, but they're not listed on the income statement. We'll start off our examination of the cash flow statement first with cash flows from operating activities. The first item we'll input is net income, which is taken directly from the income statement. Then we must adjust for non-cash items such as depreciation, amortization, stock-based compensation, goodwill impairment, PP&E write-downs, deferred income taxes, and any gains or losses on investment sales. All of these items will be added back to the cash flow statement except for the effects on investment sales. Gains will be subtracted and losses will be added as no cash was exchanged. The cash inflow from any investment sale will be accounted for, but under cash flow from investing activities instead. For example, if an investment was bought for $100 and then was subsequently sold for $90, then there will be a loss of $10. This loss will actually be added back under cash flow from operating activities. But the sale of $90 right here would actually be recorded under cash flow from investing activities. Okay, the last item here is change in net working capital and factors in changes in operational balance sheet items during the period. These operational balance sheet items include changes in accounts receivable, change in inventory, change in prepaid expenses, change in accounts payable, change in accrued expenses, and change in deferred revenue. For items that exist within the assets side of the balance sheet, such as accounts receivable, inventory, and prepaid expenses, an increase would mean that cash has actually been spent to attain these assets, so that will translate into a cash outflow. So increasing these items will translate into a cash outflow. For items on the liabilities side of the balance sheet, such as accounts payable, accrued expenses, and deferred revenue, an increase would mean that, so these items here, an increase would mean that cash has been spared or has been collected early, so it will be registered as a cash inflow. So it would actually increase your cash balance. To get a better sense of net working capital, imagine you had $100 in accounts receivable. We'll just call it AR. And this is in period 1. So in period 2, you have $90 of AR. This reduction in AR will mean that $10 from the receivables balance was collected as cash. And it would therefore increase the cash balance. Similarly, if accounts payable decreased from the previous period, that would mean that the company had to pay cash to settle its accounts payable balance. We'll touch on change in net working capital later, but let's first move on to the other major components of a cash flow statement. Under cash flow from investing activities, we have capital expenditures, or CapEx, and this encapsulates any purchase of property, plant, and equipment, or PP&E. Next up are any sales of PP&E, and similarly, there are line items for the purchase of short-term investments and long-term investments, along with any sales of short-term investments and long-term investments. So you would typically see these line items here, including these line items here, on a cash flow statement in one form or another, but there are other items such as the acquisition of a business, sale of a business, and proceeds from maturities of securities that may be listed as well. So purchases, these items here, also acquisition of business. So these items here are negative, because they used up cash, and sales, so what we call proceeds, are positive because cash was received. So we're receiving cash, it will be a cash inflow. Cash inflow. To illuminate on a difference between a sale of a security versus a maturity of a security, so these items here, wrong item. So sale, let's just do sale long-term investment versus proceeds from maturities of securities. Let's imagine this scenario. If a company has invested in a $100, so $100 10-year bond and sold it at year 7, so year 7, sold it for $98, then it's considered a sale. Whereas if the company held that same bond until maturity, so year 10, then it will receive $100, and that would constitute as proceeds from maturity. The last piece of the cash flow statement is cash flow from financing activities. Items under here include anything that has to do with debt principal, equity, and dividends. More specifically, it will detail out the amount of debt raised, the amount of existing debt that's being paid off or debt repayment, any equity issuances, share repurchases, and dividends that's been issued. There may be some other items listed here, but essentially it shows the cash raised to fund the business and the cash spent to pay back stakeholders of the business. By the way, I just want to clarify that stakeholders represent both debt and equity investors. So stakeholders include both debt and equity holders, whereas shareholders are just those who own equity or own a share of the business. So the distinction that we just made right now will come in handy when we discuss how value is returned in later courses. So debt raised and equity issuances are cash inflows, so increases our cash, whereas debt repayment, share repurchases, and dividends issued are cash outflows. Dividends are a cash outflow because cash is paid to existing shareholders. The last piece of the cash flow statement is cash flow from financing activities. Items here include anything that has to do with debt principal, equity, and dividends. More specifically, it would detail out the amount of debt raised, the amount of existing debt that's been paid off, any equity issuances, share repurchases, and dividends that's been issued. There may be other items listed here, but essentially it shows the cash raised to fund the business and the cash spent to pay back stakeholders of the business. By the way, I just want to clarify that stakeholders represent both debt and equity holders, while shareholders represent just equity holders. So those who own a share of the business. Now, this distinction will come in handy when we discuss how value is returned in later lessons. So debt raised and equity issuances are cash inflows. So they will increase our cash balance as either a loan is taken on or a share of the business is sold, while debt repayments, share repurchases, and dividends issued are cash outflows. And dividends issued is a cash outflow as cash is paid to existing shareholders. So continuing with our previous trend, we'll take a look at Apple's statement of cash flows. And recognize that we're also looking at a period of 2019, which had a fiscal year ending in September. So much like our income statement and our balance sheet. So starting from the top, we have net income. In this case, they actually labeled it for us and called it starting line. Then we have our non-cash adjustments, in which case include depreciation, amortization, and deferred taxes. So adding in other funds gets us to a funds of operations or firm operations, which is at 72.88 billion. So this line item right here. And we got that number from adding net income plus our depreciation and amortization subtracted by our net taxes, or our deferred taxes. Next, we'll assess our change in working capital. We can see that Apple had a decrease in receivables that year, which resulted in a cash inflow of 3.18 billion. An increase in inventories, a decrease in accounts payable, and a net change in other assets and liabilities that resulted in a $4.45 billion decrease in cash. The net result is a $3.4 $3.49 billion decrease in cash from changes in working capital. So that is just adding all these figures together to get the 3.49. So funds from operations plus changes in working capital gets us to our net operating cash flow. And that number here is 69.39 billion. Under investing activities, we can see that Apple has spent $10.5 billion in capital expenditures and $0.62 billion in acquisitions. So $98 billion worth of securities were either sold right here or they matured, while 40.63 billion were purchased during that period. So this meant that there was a cash inflow of 58.09 billion as there were more sales or maturities of investments than there were purchases. So ultimately, cash from investing operations or investing activities results in a cash inflow of $45.9 billion. So that is our capital expenditures plus the purchase / sales of investments gets us to net investing cash flow. Of course, we're also taking account of changes in other funds as well. So moving on to financing activities, we can see that Apple paid dividends of 14.12 billion, repurchased 66.9 billion of stock, and issued 0.78 billion of common and preferred stock. So their net change in capital stock is 66.12 billion, and that is a cash outflow as most of that is from the repurchase of common and preferred stock. So on the debt side, Apple paid off 5.98 billion in current debt, so that is debt that was going to be due during that period. They also issued 6.96 billion in long-term debt and pay back 8.81 billion in existing long-term debt. Now, you might be asking why Apple chose to pay off old debt and issue new debt. So why not just keep existing debt on the books and not issue new debt? Well, there may be a variety of reasons. They may want to refinance old debt at a lower interest rate, or the reduction in long-term debt was a result of amortization schedules in which a portion of principal is paid off over time. These items get us to a net financing outflow of 90.98 billion, and this large outflow makes sense for a mature company such as Apple, since their focus at this stage is to return value to shareholders through share buybacks and dividends. Cash from operating activities right here. Plus cash from investing activities plus cash from financing activities gets us to a net change in cash of 24.31 billion. This free cash flow line down here is not typically seen on a cash flow statement. Sometimes it's included, but it is calculated by subtracting funds or cash flow from operating activity right here minus capital expenditures. And this amount represents the 58.9 billion represents the amount of cash left over to pay back stakeholders after accounting for operational expenses and capital expenditures. Keep in mind that this free cash flow figure right here is different from free cash flow to firm and free cash flow to equity. You may have heard of those, but we'll go into more detail on these items in our discounted cash flow lessons. Let's move on now to our cash flow exercise. We'll build on the same information used for our income statement and balance sheet lessons to derive Libra's cash flow statement. As always, feel free to tackle it on your own first or follow along as we walk through this exercise. So much of this has already been inputted on the income statement and balance sheet, but to review, in year one, we took out a 5-year bank loan worth $100 with an interest rate of 4%. We also raised $400 in investor capital for shares in the business, and with this financing, we purchased a factory for $200 in which will depreciate on a straight line basis for 20 years. We also purchased $50 worth of equipment which will depreciate on a straight line basis for 10 years. To ensure that we produce the best scales, we also acquired a patent that's worth $50 and will expire in 10 years. And to produce our scales, we purchased $50 worth of materials in which only $30 have been paid for in cash. So that's actually a new variable. Our produced scales were sold for $100, but only $70 has been received during the period. So we also pay wages of $8 in cash, but $2 was paid for in stock. We don't have to worry about sales and marketing, research and development, and utilities, as those were paid for with cash as they were incurred. Since we paid $10 for a 10-year insurance policy and therefore only incurred $1 for the year, we will have to account the $9 as prepaid expenses. Similarly, since we incurred $5 worth of consulting services, but only paid $2, we'll have to assign the remaining $3 as accrued expenses. We don't have to worry about taxes on a cash flow statement as net income on the top line already factored in. So that's it. It's a lot to digest, but we'll dig into it and get it all sorted out. Okay, so we'll get started with the cash flow statement and go down the lines to fill out our year one activity. We'll begin with our net income figure, and as you can see, I've gone ahead and filled it in with our completed or from our completed income statement. In practice, you'll most likely link it in from the income statement, but since we have each statement under separate files, it's cleaner to just hard code it. We'll go over linking and hard coding in our financial modeling course. The next few items are going to be our non-cash expense adjustments, so our depreciation, amortization, and stock-based compensation. The depreciation inputs are broken out for clarity, and we have factory and equipment under that category, but in real life, they are almost never shown this way. Instead, all depreciation will be aggregated under a depreciation schedule, and the total will be inputted into the statement of cash flows. This is going to be a review from Libra's income statement exercise as we walk through these non-cash activities. So for depreciation, we have our factory, and since our factory was purchased for $200, it has a useful life of 20 years. The depreciation per year will be $10. So the way we do that would be $200 divided by a useful life of 20 years. That gets us to $10. For equipment, the depreciation each year will be $5, as it was purchased for $50. It has a useful life of 10 years. These two depreciation numbers add up to, so we'll do sum add up to 15. Our amortization amount on our scale patent is $5, and that's calculated from our value of the patent, which is $50, divided by its useful life, or in this case, how long till the patent expires, and that's 10 years. Next, we look at stock-based compensation, and since we paid $2 in wages as stock, and therefore there were no cash expenses, we will have to put that $2 in here Oops. So it's added back into the cash flow statement. We then add together our net income for the year. So that's $2 plus our depreciation, amortization, and stock-based compensation to get our funds from operations, and that is $24. Remember, we're adding the non-cash expenses as they were subtracted from our income statement, but no cash was spent. Changes in working capital encompasses accounts receivables, accounts payable, prepaid expenses, and accrued expenses in this example. And since we're logging in year one's cash flow activities, we're going to start off with $0 balances for all these items. For receivables, since we sold $100 worth of scales, but only received $70 in cash, that means there's a receivables balance of $30. Since we're starting off from a base of 0, it'll mean that our receivables will have increased by 30. Since the receivables balance is an asset and adding the receivables means collecting less cash, we will have to set it to be a negative number. For accounts payable, since we bought $50 worth of scales but only paid $30, that means we've accumulated $20 worth of accounts payables. As accounts payable is a liability and adding it means that we're withholding in cash, this will be a positive number. Prepaid expenses will be $9 since we paid $10 in cash for the insurance policy, but only accounted for 1 year's worth of expenses at $1 on the income statement. Prepaid expenses is an asset, so adding to it means that cash was spent beforehand to attain it. Therefore, an increase will result in a negative cash contribution. Accrued expenses will be $3 as we've accounted for the full $5 worth of consulting services, but only paid $2 in cash. Accrued expenses is a liability, so adding to it would mean that cash was saved, therefore increasing our cash balance. We then add together, so sum all these items to get our changes in working capital, which is at negative $16. We then sum our changes in working capital and our funds from operations to get our net operating cash flow at $8. Under investing activities, the only item we have for Libra at year one is capital expenditures. Specifically, we have a factory that we spent $200 to purchase and equipment which we spent $50 to purchase. That gets us to a sum of $250. And since we actually spent cash to acquire these assets, it would be a negative number as it's a cash outflow. Under financing activities, we raised $400 worth of equity and $100 worth of debt. This gets us to a net financing cash flow of $500, and you can see that we raised debt by taking out a loan, we raised equity by selling shares. So we actually attained $500 in cash during this period. Adding together cash from operating activities, cash from investing activities, and cash from financing activities, we get a net change in cash of $258 for this period. However, if we look at our free cash flow, and that is taken from our operating cash flow plus our capital expenditures It gets us to a free cash flow figure of $242, negative $242, which meant that we had to raise financing, and you can see that here. Intuitively, this makes sense since we're just starting out and we require financing to fund our startup. But further on into our business, we will scrutinize the free cash flow figure to see how much cash, if any, is left over after operations and maintenance of capital assets. And just to review, these items here are capital assets. So congrats, we finished our cash flow statement exercise, and in the next lesson, we will work on linking all three statements together and having a complete set of financial statements.